Pass 2 talks about your inventories. So inventories is one of your most common asset aside from your cash, primarily because most businesses engage into the selling of your merchandise rather than servicing. So we take a look now on the standard which covers the accounting for your inventories. Of course, before we start, we need to define what is an inventory. Under Pass 2, inventory is defined as assets held for sale in the ordinary course of the business. And another is assets in the production process for sale in the ordinary course of business. And another, materials and supplies that are consumed in your production. Actually, this definition of your inventory is more appropriate for a manufacturing company rather than your merchandising company. So, the definition of your inventories under pass through is only an enumeration of your different inventories in your manufacturing firm. And what are those? We have your raw materials inventory. These are your materials and supplies that are consumed in production process. Another, we have your work in process inventory. Those materials and supplies placed into your production process, however, not yet completed. So these are placed in your production, but not yet complete. And then lastly, we have your finished goods inventory. These are your items placed in your production process and are complete. So in your past two, actually, inventory was not defined as itself, but an enumeration of your inventory was given. What are those? Held for sale on the ordinary course of your business, your finished goods inventory. In the process of production for such sale, we call that your work in process inventory. And lastly, in the form of materials or supplies to be consumed in the production process or in the rendering of services, we call that your raw materials inventory. However, for merchandising, we have only the term merchandise inventory. But whatever is the term used, so long as that is an inventory within the definition of pass 2 applies again. Pass 2 applies on these three items: raw materials inventory, work in process inventory, and finished goods inventory. So, what are the excluded inventories? So, other inventories that you might encounter as you go through in your course in accountancy are the following. First, we have your construction in progress or CIP. Sir, what is a construction in progress? So if you are a construction company, so your main business is construction, and you have different deliverables as to the construction of a particular building or whatsoever. So while that particular infrastructure is to be produced or to be done, we have in progress. So halimbawa, may infrastructure ka, kino-complete mo pa lang, ang tawag doon ay construction in progress. So what will happen to that? Will that be part of your inventory? So it is not within past 2. So take note, what are the items under past 2? Only the 3 items. So these items are not included in past 2. First, your construction in progress. Why? Because there is a separate standard for construction in progress. That is your past 11 construction contracts. Okay, so construction in progress happens if ever you are undergoing construction and the construction is not yet complete. So the standard, not past 2, but past 11. Next, if you have of inventory of investments. Sir, what do we mean by inventory of investments? Nowadays, trading is very rampant. So you trade stocks, you trade bonds. So when we talk about your investments, you have two types of investments. That is either investment stock or investment in bond. Now, for investment stock or investment in bond, they are called financial instruments. Now, if you have financial instruments and you have inventory of them, so for example, you hold stocks of different companies, so BDO, BPI, Jollibee, McDo, Apple, you have those different stocks. So we call them inventory of stocks. So even if they are considered inventory of stocks, they are not under pass two. Okay. So what is under pass two again? RMI, work in progress or work in process, and then we have your finished goods inventory, but not within. First, you have your CIP, which is under pass 11, and then financial instruments not within pass 2, but under PFRS 9. Lastly, your biological assets under your agriculture. So your biological assets are your assets which undergoes your biological transformation, such as that is particularly living animal or living plant. So any living animal or living plant undergoing biological transformation is called bioassets. And these bioassets are not within PAS 2, but are within, but it's within PAS 41. Again, what are the items within PAS 2? RMI, work in process, and your finished goods inventory. What items are not within PAS 2? So we have your CIP under PAS 11, financial instruments under PFRS 9, and biological assets under PAS 41. Now, after knowing the different items of our inventories, we take a look into your measurement of your inventories. So how do we measure your inventory? We measure your inventory initially at cost. The question is, what are the items of cost? In the measurement of your inventory at cost, your cost is composed of three items. So the first item is your cost of purchase, and then we have your cost of conversion, and then we have your other costs. So we call this one your directly attributable costs. Okay, how do we measure? Remember when we talk about your introduction on your CFAS, generally your standards will always provide you when to recognize, when to measure, and what to disclose. So here we're done with your recognition. When can we recognize an inventory, if ever, that particular item is RMI, work in process, or FGI? What items are not recognizable under inventory? We have your CIP, we have your financial instruments, and we have your bioassets. Now we go with your measurement. When we talk about your measurement, always place in your minds that for measurement, we need to know the initial and subsequent measurement. So when we say initial measurement, that is the measurement at the time of recognition. When we say subsequent measurement, that is your measurement after your recognition. So this is your recognition date. We call that your initial measurement. After that, we call that your subsequent measurement. So we go with your initial measurement of your inventory. In your initial measurement of inventory, we said we initially measured it at cost. And what are the items of cost? First, you have your cost of purchase. Second, we have your cost of conversion. And third, we have your other costs or directly attributable costs. We start first with your cost of purchase. Your cost of purchase of inventory, of course, is comprised of your purchase price, your import duties, and your non-recoverable taxes, including any freight costs. Right. So for your cost of purchase, this includes your purchase price plus your import duties plus your non-refundable taxes, including any transport and handling costs. Okay. So first, on your cost of purchase. On your cost of purchase, for your purchase price, so whatever is the price you paid for the purchase of your inventory, that is the amount of your cost of purchase. That is your purchase price. So for example, you purchase your inventory for 500 pesos or 500,000, you pay it at 500,000. That is your purchase price. And for your import duties, this is in case you imported your inventories. So generally, before you can get your inventories out of that particular importation, you need to pay custom duties to the Bureau of Customs. So whatever is the custom duties you paid to the Bureau of Customs is known as your import duties. So Those import duties should also be included in your cost of purchase. Next, we have your non-refundable taxes. When we talk about non-refundable taxes, before the issuance of your inventory from the customs, you need to pay a business tax. Sir, what is a business tax? A business tax is normally a tax out of your consumption of your inventory. So since you purchase an inventory, meaning you consume, you are subject to a consumption tax. And that consumption tax can either be refundable or non-refundable. When we talk about non-refundable taxes, these taxes cannot be offset to other taxes. So generally, when we talk about taxes that is either a business tax, that business tax can either be VAT or percentage tax. So VAT is a top up tax out of your purchase, while your percentage tax is only a certain percentage out of your total purchase. Now, when we talk about non-refundable tax, between the two, VAT is a refundable tax, while the other is not refundable tax. So when you include your purchase costs, you only include non-refundable tax. Therefore, your cost of purchase should exclude VAT. Okay? Take note, when we talk about non-refundable taxes, these taxes cannot be credited or be refunded from the government. Therefore, that is in the form of a percentage tax. When we say it is a VAT that can be refunded, value added tax can be refunded. Therefore, if ever you are to measure your inventory, your cost of purchase should exclude VAT. And lastly, you should include any transport or handling costs, such as your freight costs. So any cost of transportation or handling should be included. So what should you need to take note in the cost of purchase? The items are your purchase price, import duties, non-refundable taxes, and your transport and handling costs. What you need to take note of this is your non-refundable taxes because this is new to you. Your non-refundable taxes talks about your taxes other than VAT. So in short, if ever there is a cost of purchase, you exclude VAT. Other taxes, you include them because they are non-refundable. The only refundable tax is VAT. The only refundable tax is VAT. Therefore, here, your non-refundable taxes should be all taxes other than VAT. So in cost of purchase, take note, exclude that. Import duties, this is in the form of your custom duties. So soon, if ever you go with your IA1, that is your AE 105, your cost of purchase, such as if ever you are asked what is the cost of your inventory, what is the initial measurement of your inventory, your answer is cost of purchase, cost of conversion, and other costs. But for cost of purchase, take note of these items, especially non-refundable. Another is your cost of conversion. Another item for your initial measurement is your cost of conversion. For your cost of conversion, take note, guys, that what we include here is the fixed overhead, variable overhead, including your direct labor. In short, the overhead and your labor is your cost of conversion. So whatever is your overhead cost and your labor cost, that is your cost of conversion. But take note, your direct labor should be based on your actual direct labor cost, while your fixed overhead cost should be based on your normal operating activity. And your variable overhead cost should be based on your actual. Okay. So I know you already know this one in your cost accounting. For your FOH, it must always be based on your predetermined overhead rate. That is your normal operating activity. While for VOH or your variable overhead, it is to be based on your actual variable overhead. And for labor, it's still actual. Okay? So actual, normal. Normal or standard. Okay? So cost of conversion, two items. OH, overhead, and your labor. For overhead, VOH and FOH, you should know how to measure them, and your labor, how to measure them. Next, other costs. When we talk about your other costs, these are your directly attributable costs. When we talk directly attributable costs, these are your costs necessary for the present location and condition of the asset. Okay? When we talk about your other costs, these are costs necessary for the present location and condition of the asset. So anything that is appropriate so that you can make use of your asset. So for example, your other non-production overheads can be included. So what are your non-production overheads? Uh, your design, your cost of designing the products, especially if that is for specific customers. You get specific orders for specific customers and you have specific designs for that product. That cost of a specific design is considered as a directly attributable cost because without that particular design for a specific product, you cannot make use of that product or you cannot bring that product. So that is a necessary cost for the present location and condition of the asset. Okay, once you know that a particular asset is considered an inventory based on our previous discussion, when we talk inventory, that is RMI, work in process, and FGI. Now, once you determine it is any of the three, you can now measure it. When you measure it, first at the time of recognition, we call that your initial measurement. And what is your initial measurement? Your initial measurement is composed of your cost of purchase, your cost of conversion, and your other costs. What should you take note in your cost of purchase again? That a non-refundable tax should be included. Therefore, a refundable tax is excluded. And what is your refundable tax? VAT. So refundable tax is excluded, non-refundable tax is included. In your cost of conversion, what you need to take note, how to get for that cost of conversion. We use actual for variable overhead, including direct labor, the actual cost, while we use your normal cost based on your fixed overhead. And then lastly, we have your other costs or directly attributable costs. These are your costs necessary for the present location and condition of the asset. We go now to your subsequent measurement. So once you initially measure it, you can now subsequently measure it. When we talk about your subsequent measurement, we use your LC and RV. Sir, what is LC and RV? You compare the cost, lower of cost, and net realizable value. Lower of cost and net realizable value. In your lower of cost and net realizable value, of course, we compare the cost. What is this cost? That cost is the initial cost to your net realizable value. So there is a new term here. That is your net realizable value. And what is a net realizable value? Your net realizable value is the estimated selling price in the ordinary course of the business, less any estimated cost of completion, including estimated cost to make the sale. So in short, your NRV is equal to your selling price, less cost to complete, less cost to sell. Okay? NRV is defined under pass 2 as selling price less cost to complete. What is cost to complete? These are your costs necessary to complete or finish that particular inventory. Cost to sell, that is your estimated cost to make the sale. Okay? So initially, you measure it at cost. Subsequently, you measure it at lower of cost and net realizable value. So let's say you have here A, B, C. Inventory A, inventory B, inventory C. This is the cost and this is the net realizable value. So let's say the cost is 300,000, 280,000, and then 400,000. So this is 330,000, 220,000, and this is 310,000. Okay. So initially, this is your measurement at cost. Subsequently, you get the lower between cost and NRV. So inventory A, which is lower, 300 versus 330, the answer is 300. Inventory B, 280 versus 220, lower is 220. Inventory C, 400 versus 310. The lower is 310. So how much then is our LCNRV? Our LCNRV is 300 plus 220 plus 310. This will give us 830,000. What do we call this 830,000? That is your subsequent measurement. Okay, so again, LCNRV. You just compare the cost to the net realizable value. So when you compare the cost and the net realizable value, how do we compute for NRV? NRV is equal to your selling price less cost to complete less cost to sell as defined under PAS 2. Now, when we talk about your lower of cost and NRV, you compare it on item per item basis. So we have here A, B, C. We compare it item per item. So item A or inventory A, which is lower, 300. Item B, which is lower, 220. Item C, which is lower, 310. Therefore, what is our LCNRV? You get the total. 300 plus 220 plus 310, 830,000. That is the amount of our lower of cost and NRV. Are we clear on your lower of cost and NRV? Okay. So perhaps your question now is, what will happen to your cost? Initially, our total cost is 300 plus 280 plus 400, 980,000. So your question perhaps is, what happens to the difference? The difference is considered a write down. The difference is considered as a write down. So your write down of inventory is considered as a loss. Your write down of inventory is considered as a loss. So sir, how should we account for that loss? There are two methods to account for that loss. First, we use your direct or your cost of sales method. So any write down on your inventory should be recorded initially on your cost of sales. So we debit cost of goods sold, credit merchandise inventory because it's called direct or cost of sales method. We reduce your merchandise inventory and we record your cost of goods sold. And then another method is your loss or allowance method. We record here with a recognition of an allowance. Allowance for write down of inventory. Okay, so let's go back on this particular slide. What did we talk about this particular slide in your measurement after your recognition? So initially, you will recognize it at cost. Items of cost, we have your cost of purchase, cost of conversion, and your directly attributable cost. After your recognition, how do we measure it? Your lower of cost and NRV. So how do we do it? You compare the cost to the net realizable value. Whichever is lower is your LCNRV. When we talk about your NRV, that is selling price less cost to complete, less cost to sell. Now, you do your lower of cost to net realizable value item by item basis. So item by item A, item B, item C. That's how. You will not compare the total. Hindi ganon. But we do it item by item. Now, if ever we have your lower of cost or net realizable value again, and the difference now, of course, is lower. So 980 versus 830, we have a lower amount. The difference is called your inventory write down. Inventory write down. So that inventory write down is considered a loss. The question is, how do we account for that loss? In accounting for that loss, you can use two methods. What are those two methods? Direct method or your cost of sales method, wherein we directly record it to your cost of goods sold and reducing the merchandise inventory. And then we also have your loss or allowance method, wherein we set up your allowance on the write down of your inventory. And any write down should be adjusted on that particular allowance. Okay, so I hope we are clear here in your measurement, initial and subsequent measurement. We go now to your cost flows. So, what is a cost flow? Actually, your cost flow or your cost formulas generally talk about on your how to identify the cost to a particular inventory. So, how do you identify the cost to a particular inventory? So perhaps you purchase too many inventories. So let's say you purchase 10,000 inventories. And on the 10,000 inventories, you sold 6,000. And definitely, the 10,000 purchase of inventory has different purchase price. So 10,000 inventory, bumili ka, syempre iba-iba yung purchase price yan. Nakabenta ka ng 6,000. When you talk about your cost flows, saan kaya nanggaling or magkano yung cost ng 6,000 na binenta mo? So out of your 10,000 purchases, saan yung purchase price dun sa 6,000? That is what we address under your cost flow. So we try to identify. So generally, you have here your inventory. Your inventory can be sold. That is your cost of goods sold. And your inventory can have remaining inventory. We call this your ending inventory. So your initial inventory can be broken down into your sold inventory, your cost of goods sold, and your remaining inventory at hand at the end of the period. We call that your ending inventory. Now, our problem here is how should we allocate the cost of our inventory on the sold items and your remaining items? So your standard provides you your cost flows. At some point, your cost flows are known as your cost formulas. And what are these cost formulas? First, we can use your specific identification, but take note, you use only specific identification if in case they are not interchangeable. So meaning, it is a unique inventory. You can identify it. Sir, paano kung panay cellphone lang na same unit kami? O, di ba? So, same unit ng cellphone lang lahat ng benta mo. So, Apple, iPhone 12. So, yun lang. Yun lang yung inventory mo. So, it is interchangeable. Hindi mo alam kung saan mo binili itong iPhone 12 na to, yung isang iPhone 12 na to, baka saan mo binili din. So, you can interchange them. Kasi nga, they are the same. But, if ever it is not interchangeable, meaning you have iPhone 12 here that is only very particular, you have Pro Max, you have different phones but with different types of inventory, it cannot be interchanged from one another. So since it cannot be interchanged, you can determine the specific cost. The cost formula you use is your specific identification. You can attribute them to a specific individual inventory items. Okay, so if ever that is a specific identification, you can attribute them to specific individual items of inventory. But once it is interchangeable, you can use your first in, first out, or weighted average. So in your first in, first out, it is assumed that the first purchase is the first sold. The first purchase is the first sold. So for example, you purchase on February 1, February 5, and then February 12. 500 inventories at 50 pesos per inventory. 600 inventory at 48 per inventory. And then 800 at 40 per inventory. So if ever you have determined that you sold, let's say 800, in FIFO, the first sold or first purchase is first sold. So in that 800, nanggaling agad yan dun sa una mong purchase. So 500 na yan. Magkano pa natira? 300. Saan naman manggaling yon? On your next purchase. So dito na. On your FIFO, the first purchase is first sold. So if you sold 800, that will come first on your first purchase. Since it is not enough, you go to your next purchase. Until then, you can satisfy it. Clear? Okay, that's for FIFO. For weighted average, we compute for your average cost, and that is your cost of your inventory. For your weighted average, we compute for your average cost, and that is your cost of inventory. Under weighted average, we have two types. We have your weighted average periodic and weighted average perpetual. When we talk about weighted average periodic, you compute for your simple average cost. Sir, why simple average cost? As the term itself, weighted average periodic, the average for the period. So in short, you get for the total cost of your inventory, and then you just divide it to your number of units of inventory to get for your simple average cost. Weighted average periodic. Okay? Get the average for the period as the term implies. Next, we have your weighted average perpetual. Weighted average perpetual. When we talk about weighted average perpetual, we call this one your average changes perpetually. So you call this one as your moving average. So this one, your average changes every time there is a new purchase. Your average changes every time there is a new purchase. Okay, so FIFO, whether periodic or perpetual, it is the same. The first purchase is the first sold. So if you sold 800, you attribute it to your first purchase. If not enough, to your next purchase. For weighted average, we have either weighted average periodic and weighted average perpetual. When we talk about weighted average periodic, that is your average during the period. So you just need to get for your simple average cost. That is your total cost divided by your units. In your weighted average perpetual, on the other hand, we get for your perpetual average, wherein your average changes perpetually. And the change is dependent whether there is a new purchase. So every time there is a new purchase, you compute for a new average. We call that moving average. Okay, so in our standard, it provides if you can identify it, then it's specific identification. If it is interchangeable, then you can use FIFO or weighted average. Further, Path 2 also provides that in getting for the cost of our inventory, cost of goods sold, and ending inventory, we can use your cost and retail methods. Cost and retail methods to use your approximate actual cost. So generally, guys, to get for your actual cost, that is to your sold and your remaining inventory, what items do we use? Is specific identification. We use also your FIFO or weighted average. But if we try to approximate the cost, what do we use? We use your retail inventory method. So that is your cost and retail method, including your gross profit method. Again, if we want to determine the actual cost of our sold inventory and remaining inventory, what are the methods used? Is specific identification, first in, first out, and weighted average method under PAS 2. But if you want to approximate, then we can use your retail inventory method and your gross profit method. Third question, can we use your approximated method for our financial statements? Approximated method cannot be used. It is only for internal reporting and at the same time for our interim financial statements. What is an interim financial statement again? That is a financial statement not covering a whole period. Okay? Clear? First, we need to recognize it. After recognizing it, we need to measure it. So we know already initial and subsequent measurement. Now, our problem in case is that if ever we have your costs, and then we need now to determine our cost flow as to what amount is sold and what amount is remaining. What are the methods provided under the standard? Specific identification, FIFO, and weighted average method. And if ever we want to approximate it, retail inventory method and your gross profit method. Are we clear? Okay. Now, your expense recognition. So you're done with your measurement, you're done with your cost flow. So on your cost flow, what do we determine again? The amount sold and the amount of our remaining inventory. The amount sold is known as your cost of goods sold. So this cost of goods sold is considered an expense to be placed in your income statement or your statement of comprehensive income. Your remaining is known as your ending inventory to be presented as part of your asset in your statement of financial position. So, in your expense recognition, you will only recognize it when they are sold and revenue is recognized. What do we call them? Cost of goods sold. How about the remaining? We call them ending inventory as an asset placed in your statement of financial position. Are we clear? Okay. So, what did we learn about past two? Pastel provides you on your recognition and measurement criteria for your inventory. What items can be included in inventory? Three items only. Once you know those three items, then you use past two. What are those? Your work in process inventory, your raw materials inventory, and your finished goods inventory. At the time you recognize those inventory, how do you measure it? At cost. What are the items of your cost? Cost of purchase, cost of conversion, and your directly attributable cost. Subsequently, you can measure them at lower of cost and net realizable value. Please take note of what costs should not be included and what costs should be excluded. Further, after that, we need to know the flow of those costs. So we have your cost flows. Cost flows to know your actual cost, we have your specific identification, FIFO, and weighted average method as provided under PAS2. But if you want to approximate, you can use your retail inventory method or your retail method and also your gross profit method. Further, once you already know the cost flows, you are ready to classify the costs as to what amount should be included as an expense on your income statement and what amount should be included as an asset under your statement of financial position. That's it for past two inventories.